Okay, last night we saw a rout in US stocks and a flash crash in gold and silver. Yet today, everything is already repairing itself. Is the market risk truly resolved, or are the smart money players taking a trap for us? Let's break down exactly what happened last night. The main driver behind the volatility was actually Kevin Rush's testimony. He made it clear that he won't be a puppet for the president and interest rate decisions must remain independent. And more importantly, he emphasized that if appointed, he intends to push for balance sheet reduction to drain excess liquidity. Notice this, after his comments, the dollar jumped, treasury yield spiked, gold dropped over 2%, and US stocks futures tumbled. Why? Because his words completely shattered the market's fantasy that wars equal to a rate cut proxy. The market had priced in a new chairman who would be dovish and cut rates easily, and instead watched over no promises of cuts in highlighted inflation cursors. What the market fears most is this double whammy of tightening liquidity plus policy uncertainty. And his story proves that whenever the Fed attempts aggressive balance sheet reduction, QT, the market responds with a crash. Think Q4 2018 or the bear market of 2022. War just pressed the stress test button on risk assets. And therefore, from a medium-term perspective, his hawkish stance is a significant headwind for risk assets, capping the upside for gold, silver, and stocks. But why the rebound today? It's largely because Trump hit the brakes, tackle, announcing an indefinite extension of the ceasefire, combined with faster signals from Iran regarding continued negotiations. We are seeing some subtle but critical signals from Tehran. And just today, they announced the full resumption of domestic civil aviation. Basic physics tell us nobody puts fully loaded passenger jets in the sky if they expect to get bombed. This move is the clearest signal of de-escalation. Some might even call it a form of capitulation. And plus, the Iranian stock market plans to reopen in 10 to 12 days. These actions speak louder than any tough rhetoric. Despite bargaining over the ceasefire, the market realized geopolitical risks are fading. What does this mean for oil and gold? Given world's hawkish outlook and falling oil prices, gold is likely to continue consolidating within a large range. With mixed signals, it can fall deep, can rise high. As for crude oil, while the de-escalation removes supply fears and drains the war premium, the recovery pace of global demand remains uncertain and the trade is still not fully open. Oil is currently being pulled by these conflicting forces, making it too early to confidently bet on a bull or bear trend. As always, this is just my personal trading analysis, not financial advice. And also, shout out to ABC Financial Group for sponsoring this content.